Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today's Friday the 13th. It's 7:36. The market's going to open up in a little bit less than 2 hours, about an hour and 53 and a half minutes to be exact. Before we begin, I want to talk a little bit about something, and this is important. And if you're ever wondering, why do I watch this video? Why do I watch this Roger Scott guy, this guy who talks a lot in the mornings about stuff? I want to show you something interesting. This morning while I was in bed, I couldn't sleep. It was warm. It's getting hot, and I didn't have my AC on, so I was just turning and tossing, and I went on CNBC real quick. I get these an email with 5 topics every day, and I see this as the top topic. Millions of people around the world would die if Ukraine's Black Sea ports aren't reopened. Vladimir Putin reopened channels, military support Ukraine, barley, wheat, corn, foods. They need food. World food shortage. Now, do you guys remember somebody talking about this almost every single day for the last 2 months since the war started, and talking about Kraft and Hershey's and Hormel and Campbell's Soup, and how all of these goods that are not perishable are going to be shipped back there, and how everything we saw with COVID and the lockdowns in our ports, how it's all going to go back now to Europe, and how there's millions of people from Ukraine and Poland and Hungary that don't have food, and we're going to be shipping and getting food over there, and there's going to be a major bottleneck in the global supply food chain. I've literally been obsessed with that topic since the war started, and to me this was very obvious. This is the first headline that I saw about it, and I've been talking to you guys about it, and I've been showing you these stocks almost every day. Hershey's, we talked about Campbell yesterday, we talked about Hormel. I almost bought an option yesterday, but the liquidity was too low. The point is, we've been pointing this out almost every single day. So if you want to get the news a month and a half ahead of time, this is a good place to be. And if you guys enjoy this, send me an email, support@marketgeeks.com. I want to hear from you, and put some comments in the chat. But when I saw this article today, I was like, yeah, this is big news. We've only been talking about this to our guys since the war started. It was so obvious. Now let's get into today's session. So we had jobless claims, we had PPI. PPI was very, very high, but it wasn't a record like last month. Same thing with the CPI. So there's a shred of evidence that this inflationary pressure may be coming down and that it peaked. If that's the case, then bonds should start moving higher instead of lower, and the Fed should start cooling things off. We'll see if that happens. I doubt that's happening, but there's a chance it's happening because the bonds have gone down too much too fast. Let me show you what I'm talking about. It's just way too much too fast, and it looks like they're starting to assimilate, or it looked like they started to assimilate a little higher prices, but they're backing off once again. And again, I'm looking to a short the bond market, but I can't short the bond market till we really get a rally, so I can get some leverage to the upside. Because right now, if the Fed backs off from their plan, the bond market can really rally hard, and that wouldn't be bad. But once you start seeing the bond market cooling off and not going down, that means the long bond is no longer assimilating inflationary pressure, because it would be, remember, the bonds discount everything that's known, and if there's inflationary pressure, that would be coming priced into this market. So as soon as we start seeing more choppiness, more upside, less of this crazy downside, which has already priced in most of the downside in bonds. I mean, look at this, from 155 to 111. That's insane. So expect a turn. Now, something else I want to show you guys, and this is the number of stocks in the stock market. This is any stock priced over $2. So this is really giving us a good taste of what the stock market momentum levels are like. And I want to show you guys this. We're now underground, okay? This is COVID right here. This is 2018. This is the crash. This is the big one. And if you look at these momentum levels, let me just show you something. If you look at these momentum levels on the NASDAQ, I want to show you this. This is something. This is something. Look at the top 100 NASDAQ stocks and the 50-day line. This is crazy, crazy. Look at where we're at. I wanted to show you this because this is 2008. This is 2010. So basically, this is every time the market had a real melt-off. We're at the lowest level, folks. We're at 7%. We're literally at the lowest level. We're below 2008 levels now. That's the 50-day. The 50-day could be a little reactive. So let's look at the 14 days. But I'm telling you, I mean, we're not there like down exactly, but we're getting there. Look, we're now below COVID 2018. We're reaching for the 2008 levels, but the markets don't have the type of risk they had in 2008. So I'm thinking this is going to start slowly turning, and start moving higher, which would mean more upside for the bond market. Another good clue that the stock market doesn't want to go down much more is the fact that volatility was down yesterday. Matter of fact, look, it clipped down and we still had a lot of volatility. Matter of fact, let me show you the kind of volatility we've been having. I want to show you this. 1 second. This is crazy. This is crazy. Look at the let me remove this. Look at the volatility. We're higher than we were last time we bottomed out. 11 points on the SPY. 11 points. Just to give you a flavor, typical volatility is about 12, 13. We're all the way at 19, 20, which is where we went when the COVID had the crash. Look at that, right? I mean, real close. Real. And this was a crash. So to me, it looks like the market is peaking out to the downside, and momentum levels are confirming the same. I mean, look at this. I was just looking at this RSI. Look where we were here, and look at the RSI. Look at where we are here. Look at the RSI, and look at this. I mean, if you want to see divergence, this is probably the biggest divergence I've seen in my life. I mean, look at this. Higher highs, lower price. So the market's definitely telling us it needs to pull back. Now, is this pullback going to be meaningful? Is it going to go all the way to the 200-day moving average? Are we going to make new highs? It's hard to say. Why? Because the war is a major catalyst, and we don't know when this war is going to end. And until the war ends, we're going to be very choppy and very sideways. And I think this type of market structure, let me just kind of give you an idea. Oops. I think this type of market structure, for the most part, is going to dominate this kind. I think this is an outlier. I think this is going to come back up, and we're going to kind of stay around this area right here for a while and consolidate till we start seeing what's going to go on with the market. But this is opportunities. I mean, we've been having an 80% win rate in our discretionary trades and not the rotation trades during this time on our closed trades. So this is okay because this gives us some range. But if the market just goes straight down without any elasticity to the upside, that's going to be very squirrely. Now, talking about global economy, let's talk a little bit about that. U.S. whole prices soared 11% in April. Not good, but better than last period. So we're thinking it might be the peak. Federal Reserve, Mr. I can't predict the future. Oh, wait, I can. Powell, fresh off winning Senate confirmation for a second 4-year term for the first time, acknowledged that high inflation and weakness in other economies could thwart his effort to avoid recession. At least he acknowledged it. Powell had earlier sought to portray the Fed's effort to tighten interest rates as consistent with so-called soft landing for the economy. And I think that's the change. But again, I'm not seeing that for the next 12 to 16 months. Central bank moves to fight back against price increases by rising rates are pulling some curtains lower while the dollar rises. The Japanese yen has weakened sharply in the past several months, while the Japanese yuan, whose value against the currencies is regulated, has weakened. Labor Department reported that the wholesale prices, this is what I was talking about, this is the PPI, soared 11% from a year earlier. Concerns that manufacturing costs could be passed to the consumer. But folks, they've been spending. Hopefully it'll continue. Inflation has been worsened by Russia's invasion of Ukraine. This is a big problem. And the conflict's impact on rising energy prices. China's recent lockdown, concerns about COVID resurgence also worsened the supply chains. And when I talk about the supply chain, just keep in mind this story here about things going back to the other way. Now, in terms of sectors, let's look at each sector. Let's do our little analysis here. Still, communication services on the cumulative is lagging, but again, let's look at it on a chart. And let's see communication services, and let's compare it to everything else. Well, communication services finally made a lower low, finally, but it closed higher. And it's now starting to outperform these two sectors right here. So if we can get a little more upside on this sector, it will show a turnaround. But both technology, consumer, communication, it looks way overdone. Everything is looking really overdone. The energies are looking pretty strong again. Materials looks overdone. Utilities looks like they can be kind of choppy for a while. But real estate, financials, industrial, healthcare, technology, consumer discretionary, communication, they all look really overdone, and they look like they want to go higher. Now, two stocks that I really like. Helmerich and Payne, HP. Let me show you what this stock does. Russell 2000, oil drilling stock. Not a big stock, up 50% this year. I really like this stock a lot. So Helmer and Payne, and I would get it right around here, and there's a target right around 51, and IMO, which is doing exactly the same thing. And if you look at this stock on a profile, you will see it's a $31 billion company, up 52% like the other one, and there's plenty of liquidity. Look at price forward earnings on this one. And look at price forward earnings on this one. Not even there. I mean, it's not a lot. The P ratios are not high on these stocks. And I think oil drillers and anything relating to oil is going to be on the upside over the next couple of sessions. Right now, I think we're going to go a little bit higher. That's why I haven't been shorting anything last few days. So keep your eye on the SPY, and let me give you some levels, some important levels. The first level is going to be 406, then 430. We've got a lot of upside to make up in the next couple of weeks, so I'm hoping the market's going to start strengthening out. Volatility is moving lower. Put the call ratio steady. It looks like markets want to go higher, and something interesting that I'm finding. Look at the Russell 2000. It closed higher yesterday. It actually was up 1.17%, while QQQ was down 0.69%. Now, small caps, when they start leading, they're the most speculative sector. That's a very strong sign that the market's going to start rallying. Maybe not long term, but it is speculative stocks coming up, and they've been going up the last couple of days stronger than the QQQs, is a positive sign for this market. Again, HP and what was that other stock? It was, here, let me give it to you. Oops, let me go back. Yeah, Imperial Oil, IMO, and HP. Now, before I let you go, it's hard enough to trade stocks without having to worry about all the noise and the volatility in the market right now, right? Which is why I want to share tools traders need to be successful as Wall Street rotates out of growth stocks. Sector rotation not only allows us to take advantage of potential upside momentum, but one of my best strategies includes a hedge that also protects you from downside moves, all while avoiding the volatility individual stocks can present. Click the link below to learn how this rotational strategy could help in volatile times like this, and this is volatile times. Folks, Monday, weekly outlook, biggest threats, biggest opportunities. Follow the link below this video to watch my presentation on rotation. You guys are going to love it. It's all meat and potatoes. You're not going to see flashy Ferraris or golf courses. Yeah, I don't think so. Not on that one. Take lots of notes, and if you can't find it, go to the YouTube channel. It's in the descriptor. And if you're getting benefit out of these videos, if you learned from me before CNN or Fox or anywhere else about this global food shortage, let me know. Support at marketgeeks.com or put a comment in the video. Bye, guys. Have a great weekend. Mercury retrograde and Friday the 13th. Ay, ay, ay. Bye.